Hello, I'm Demetris Theophanides, Director of XSpot Partners Ltd. Today we will review the performance of model portfolios for the month of August 2024. In addition, we will discuss the latest developments in the markets and the economy. Despite a negative beginning for the markets in August, the end of the month found most of our portfolios stable and strong relative to our benchmarks. Some of the gains in our euro currency portfolios were offset by the euro's significant strengthening by 2.2% in August, while our dollar currency portfolios moved positively. The balanced plan, with an allocation of 50% in equity ETFs and 50% in bond ETFs, is up 8.67% since the beginning of the year, while our global growth plan is up 14.56%, slightly outperforming the MSCI World benchmark. Our income and high income plans continue their excellent course with returns of 6.41% and 19.24% respectively since the beginning of the year. For the month of September, we expect the market volatility to continue. We remain cautiously optimistic for returns going forward, and we will continue to monitor the markets and will recommend changes when necessary. We consider our portfolios to be quite well positioned, and we expect positive returns for the bonds due to declining yields as we anticipate the first interest rate cuts from the Fed. Having a long-term investment strategy should provide a successful outcome over the longer term. The beginning of August has seen major equity indices fall significantly, driven largely by weaker than expected US jobs data and weaker than expected earnings from several big technology firms, which prompted fears of a recession. After a sharp decline early in the month, most major indices managed to finish August with monthly gains, as economic fears have subsided and expectations that the Federal Reserve will cut interest rates soon increased. It is worth mentioning that during the first few days of August, when the markets were under pressure, market sentiment changed rapidly, and investors began to discount the Fed's rate cut by 50 basis points as the fear of a hard economic landing was increasing. Then the markets rebounded as some more encouraging macroeconomic data were announced, and the expectations over the pace of Fed rate cuts by the Fed in September returned to the more likely scenario of 0.25%, but without ruling out the possibility of a 0.50% rate cut, as September has already started with pressure and statistically is one of the worst performing and volatile months for the markets, especially during election years. Thank you for watching another XSpot Wealth video. Stay tuned for more videos to follow.